2020 was a year of unprecedented disruption in the private equity industry, to say the least. The word that I like to use is resilience. In the early stages of the pandemic, particularly as it got to Western Europe and the United States in March and April, we really were in what I call the shock and awe phase. Private equity investors were really focused on making sure that their employees were safe, their portfolio employees were safe, that they had enough cash on balance sheets in order to survive a really unknown phenomenon that was much more akin to a natural disaster than something like a recession. And then as we moved into May and June, there began to be a lot of thinking about, well, how do I get back to work? What does the new normal look like? And how can I invest again as a private equity investor? And we saw actually the resilience of the industry show itself in the fact that deal making roared back the second half of the year. Over 2/3 of all of the transactions that were closed in 2020 happened in the back 6 months of the year. And at the end of the day, deal values actually ended up plus 8% versus 2019. Exits were broadly flat with 2019. Fundraising was down a bit, but recovered strongly in the second half. And returns actually were quite attractive, driven along by very, very solid public equity markets, as well as exits in industries that were either resistant to the pandemic or indeed or provided tailwinds from the pandemic. One number that really jumped out at me in the year 2020 was actually the number of deals transacted by private equity firms. That number was down by about 1,000 versus 2019 and prior years. So instead of the usual about 4,000 transactions that we see private equity investors doing in a given year, we saw more like 3,000. And those 1,000 deals that didn't get done tell me a couple of things. Number one, obviously, since values were up, the average deal was much larger in 2020 than it was in 2019. But importantly and secondly, it means a lot of investors did not get deals done that they wanted to do during the year 2020. And that means for 2021, there's going to be a tremendous pent-up demand for investors to put money to work because the amount of dry powder in the industry has been accumulating at record rates over the past 5 to 6 years. So there's a lot of money to invest. A lot of deals didn't get done. And already in January, we're seeing levels of activity in the market that are up well over 100% for January 2020, which in many markets was pre-pandemic. And so we think that this is a structural issue, that we're going to see extraordinary levels of activity in the private equity world, especially buyout during the course of 2020. And we're going to see it skew to the sectors that actually were very active in 2021, I should say. We're going to see extraordinary levels of activity. And we're going to see it skew to the sectors that were very active last year during the pandemic. Led by technology. The technology space, especially enterprise software, has proven itself to be very, very insulated against the effects of the pandemic. Other areas that we saw a lot of activity in 2020 that we think will continue into 2021 include certain aspects of industrial products and services like packaging and building products, certain aspects of financial services, especially digital payments and fintech, and different aspects of healthcare, especially around the service market, as well as medical devices. Those four broad industries, tech, industrial, financial services, and healthcare, accounted for over 2/3 of all of the transactions done in 2020. And we think that that skew is going to continue into 2021. So in favor sectors that are more pandemic resistant or provided tailwinds by the pandemic are going to continue to see very high multiples and very high degrees of activity during the coming year. And we've got this backlog of 1,000 deals that didn't get done on top of it. So we think it's going to be incredibly busy. Given that multiples will remain high in the industry, driven by the mountain of dry powder, low interest rates in most places, and the level of competition for assets that are resistant to the pandemic, that means the margin for error is lower than ever in the industry. And GPs are really going to have to learn to differentiate even more in order to expect the same kinds of returns over the next 10 years that they were able to generate over the past 10. Some of the ways that they will try to differentiate will be along the lines of sector expertise, for example. Sector expertise, we believe, is going to become more important than ever to survive and thrive in the private equity industry. Why is that? Well, it's because end markets and subsectors are changing more rapidly than ever before. And technology is a force that's actually changing those end markets. So if you're not expert in a specific subsector, the chances are you may get it wrong on how that subsector is going to change. And even if it only pivots by 10 or 15%, that's the difference between making money and losing money. Because as customer behavior changes or technology changes, the ability to lower costs or differentiate different offerings, that is the difference between winning and losing in many subsectors. And if you don't really understand at a microeconomic level the dynamics of a subsector to begin with, it will be very challenging to understand how that subsector might change over the next 5 years, or what is typically a private equity ownership period. Another thing that we think will change, that investors will need to grapple with as they continue to try and differentiate themselves, is the nature of the private equity industry itself. We are in the middle of a wave of innovation that's driving ever more degrees of specialization in the private equity industry. That innovation is made manifest by the number and type of different products, if you will, that we're seeing in the market right now. So things like sector-specific funds, long hold funds, growth equity funds, SPACs, sectors, low cap, small cap funds. We're seeing a tremendous plethora, ESG funds. We're seeing just a tremendous variety of products in the marketplace, and a level of innovation and entrepreneurship that is both endemic to the industry, but it's been accelerated over the course of the last 5 years. And so what we see are a lot of new funds that are actually able to that come into existence with this type of insight or this type of specific angle and specialization as their reason for existence, or their reason to be able to create, their reason to be able to convince LPs that they're going to create alpha. And then at the top, we have some very, very large funds, say, use the publics as a proxy, that are able to actually quickly pivot when they see things that appeal to LPs and drive innovation at their level and create funds that are highly specialized. But in the middle, we've got a large number of funds, the bulk of the market actually, that are either one product funds or two product funds, that are wondering both how to take advantage of this new specialization and these new angles to create alpha on the one hand, and then defensively, how to think about, are they doing enough with the core fund that they have today in order to preserve returns for the future? Or does that need to evolve? And if it needs to evolve, what does that mean for the use of technology in investing? What does that mean for adding value to portfolio companies? And what does that mean for the use of technology in order to source the kinds of attractive deals that investors want to do in order to create those returns for their investors?